Greetings, salutations, marhaban. However you say it in your neck of the woods, I'd like to welcome you to another episode of Le Art of Reading Price Action. Again, welcome to another episode of the Art of Reading Price Action. And in this episode of the Art of Reading Price Action, we will be discussing
the infamous IPDA.
Before we get started, for those who may not know who I am, my name is Timothy Lee Rogers Sr., aka Araña Grande. That's Big Spider for those that don't hablo español. And you can join the mentorship for the 19th million time by clicking the join button. It's $24.99 per month. Yes, I'm putting all the videos on the tube for free. What the $24.99 a month gets you is access to me to do the weekly homework reviews on Wednesdays at 7 p.m. You get access to monthly Q&As. As a mentee, you get access to 3 monthly Q&As, one on the first Sunday, second Sunday, and third Sunday. The first Sunday is the gold and black spiders. The second Sunday is just the mentees. And the third Sunday is the black spiders and the mentees. So that's what the $24.99 a month gets you. And you join it by clicking the join button on here on YouTube. Now that that's out of the way, let's get into Le Art of Reading Price Action, discussing IPDA. What is IPDA? Let's find out. IPDA is what Michael calls the algo, the interbank price delivery algorithm, IPDA, aka IPDA, the interbank price delivery algorithm. I know a lot of times people be like, what are you saying? That's what Michael calls it. I'm saying IPDA, right? What is IPDA? The IPDA is the market maker. IPDA is the price engine. IPDA is the algo. All these things you hear people talk about, that's IPDA. I'm a believer in one algorithm controlling the entire markets is not because Michael said it so. Matter of fact, I think what I'm going to do, I think I'll put a card there. I did my own research on this and the findings are here. I think that's where the cards go. If I remember to put a card there, there'll be a card there. If I don't remember to put a card there, go on my playlist and look for the video that says, I found the secret that makes the market move. I found ICT algos or something like that's the title. I found the secret that makes the market move. I found ICT's algo. I did my own research, and in there is why I'm a believer in one algorithm moving the entire market. It's not all the buyers and the sellers. Go watch that video and you'll see why I believe that IPDA is a real thing. I don't know if they call it IPDA. That's what Michael called it. But you'll see why I believe that IPDA is a real thing. Okay, let's get back to it. Now, IPDA, the market maker, the price engine, the algo, all the stuff that's going on behind the scenes that you're not privy to, that's what IPDA is. And speaking of all the things going on behind the scenes, when you first start studying price or start trading, you know that something is going on, but you really can't, you know something is there, but you really can't make it out, right? And the more you start to watch price and study price and learn from different people, it don't have to be ICT concepts, it can be from anybody. You start to learn that there is what Michael calls a market efficiency paradigm, meaning there's a relationship between smart money and uninformed money, smart money and speculative money. Now, when I first started trading, investing, all that, I was under the impression that the smart money was like the big hedge funds, the people with a whole lot of money, the market movers. I thought it was like, the market makers, the people that run these brokerages, the market makers. That's who I thought the smart money was. And I thought the speculative money was like retail traders like myself, like back in the day, y'all know I used to call them like Retail Rick, Risky Randy, Reckless Rachel. You know what I'm saying? I thought that was the uninformed money, right? But as I started to learn the ICT concepts from Michael, right? And like I said, you don't have to trade ICT concepts to learn this. I started to learn that there is a relationship between the smart money and the uninformed money. And the more I studied it, and when I found out about IPDA and how IPDA operates, again, the algo, IPDA, Michael calls it IPDA. I don't know if he made that up. He calls it IPDA. But when I found out about IPDA, I learned that the relationship between the smart money and the uninformed money is not that. I did a video on this before where I was saying, like, when I was a kid, we used to ride these things called big wheels. And on a big wheel, the big wheel was responsible for moving there's a cycle. It was like a 3-wheel, so you sit on it and you put your feet on the pedals in the front and you pedal. The big wheel and the 2 smaller wheels in the back just came along for the ride. But once I learned about IPDA, I found out that this isn't the hedge funds. This isn't the people with a lot of money. These are the people who understands the market efficiency paradigm. And no matter how much money you have, no matter if you're a hedge fund owner or a hedge fund guru or a so-called market maker, if you don't understand the market efficiency paradigm, you're in this uninformed money circle. You're over here. But if you understand the relationship between the smart money and the uninformed money, no matter if you trade ICT concepts, if you trade mannequin parts, if you trade on the weather patterns, if you understand the relationship between the smart money and the uninformed money and the way that IPDA operates, you are in this circle of smart money, right? Why is that? Because the way the market is engineered, it is engineered to deliver efficiently for IPDA. And everybody in this big circle is the liquidity for the smart money. The price delivery is engineered for efficiency of the smart money, meaning the smart money is the one that's controlling it. IPDA is the one that controlling it. They're controlling it. If you're over here, you're either going to be willing or unwilling liquidity. What does that mean? When your stops are taken, it can be you wanted your stop to be taken, or your stop got taken against your will, but you are the liquidity that the smart money needs to move the market. Mind blowing, ain't it? Now, if you're sitting there thinking like, Tim, you're doing a whole lot of this and I still don't know what you're talking about, we're going to get in there and show you how IPDA delivers price. Now, to understand how IPDA deliver price, you need to understand the elements of a trade setup. Now, you have your framework that's surrounding your idea, and then you have your institutional reference points. Now, imbalances and order blocks and breakers are reference points, but in this particular discussion, all of them are going to be considered reference points. Why? Because this is what IPDA refers to at the different stages of framework. Now, think about it like this. IPDA couples a framework with a PD array. Michael calls these PD arrays. I'm not here to say he invented anything. This is what IPDA does. IPDA couples a framework aspect with a PD array. Now, what are the different frameworks? You have expansion, you have retracement, you have reversal, you have consolidation, right? That's all the market going to do, right? The market is going to consolidate, meaning move side to side. The market will expand, meaning go up or down, right? The market will retrace, right? After expanding, it's going to pull back into the range, up or down. And then the market is going to reverse, meaning if it's going down, it's going to go up. If it go up, it's going to go down, right? That's the only thing that price can do. These are the stages or the framework that's surrounding your idea, right? Now, what the algo does, it couples each stage with a particular PD array, right? It couples it with a particular PD array. Now, stay with me. I don't want to lose you. I don't want, just remember that. Now, before we get into how it couples it, there's only two ways that IPDA will deliver price to the destination. Gang. What do we call the destination? Who lives at the destination? Tell me. I'm listening. I'm listening. And for those that's not part of the gang, Picasso lives at the destination. We trying to get to Picasso house. Now, there's only two ways that the algorithm is going to deliver all the way to Picasso's house, right? The market will consolidate. This is when IPDA is engineering liquidity. This is when IPDA is engineering liquidity. It will consolidate. It will expand. It will retrace. And then it will deliver to Picasso. Or it will consolidate. It will expand. It will reverse. Then it will retrace. And then it will deliver to Picasso. So remember, again, consolidate, expand, retrace, deliver, or it will consolidate, expand, reverse, retrace, then deliver. That's getting all the way to your final destination. That's getting to Picasso's house. Okay? Now, let's go back or continue forward, should I say, and show how IPDA couples it with different PD arrays. Expansion. What is expansion? Expansion is when price moves quickly from a level of equilibrium. What do we call expansion around here, gang? I'm listening. I'm listening. Yes, that's right. Pang-yow! We call it the pang-yow, right? What is important about the pang-yow? When price leaves a level quickly, this indicates a willingness on the part of the market makers, aka IPDA, to reveal their intended repricing model. Okay, now what PD array or reference point does the algo IPDA couple with expansion? The order block. When you're coming out of the consolidation, right, and going to an expansion, it's going to be that last up close or last down close candle that is at or near equilibrium, right? And if you don't know what equilibrium is, I'll explain that now. If you look at the consolidation, this is a clear area of consolidation. Now, when it comes to consolidation, if you take a Fibonacci tool and you run it from the highest high to the lowest low of the clear consolidation range, right? 50% of that range is the equilibrium of that consolidation. So when price makes an impulse move, this tannish color box here, this move here, that's the on. That's the expansion. That's the impulse move away from the consolidation. And then the last down close candle in this case, because it's expanding upward, it's impulsing up, is the order block. You don't chase price when IPDA tips its hand. You wait for it to come back to your PD array of choice. And in this case, IPDA couples the expansion with a order block. So you're looking for it to trade back into, this case, the bullish order block. And if it's expanded to the downside, it would be a bearish order block. We tracking? We tracking. Now, retracement. What is retracement? Retracement is when price moves back inside a recently created range. Meaning, when it takes off, pow! And it expands away really quickly, it creates a new price range, right? Why is this important? When price returns inside a recent price range, this indicates a willingness on the part of the market makers, aka IPDA, to reprice to levels not efficiently traded for fair value, right? You're retracing back into fair value gaps, liquidity voids, anything, any kind of imbalance that was left behind when you got that pow. Remember back when we talked about displacement, expansion, retreat. You see how everything is, see everything coming together? It's all coming together. That's why I tell y'all, don't forget about the stuff we talked about. Just keep bringing it forward, because it stacks on stacks on stacks on stacks, blocks on blocks on blocks on blocks. It builds on top of each other. Now, speaking of building on top of each other, remember in the other example of the expansion in the order block? Now, we're focusing on the sell side imbalance in this case, right? Here's a SIBI, here's a SIBI. Price expanded to the downside, right? And it left a sell side imbalance. At this point, we're looking for price to retrace back into the impulse leg, back to reprice the imbalances that it left behind. And then now that the imbalance in this case is filled, where did it stop? At the bearish order block. Stacks on stacks on stacks on stacks, blocks on blocks on blocks on blocks. So in the first example, we were looking at the retracement and the imbalance and the order block all at the same time. But you just didn't know that we was looking at it then. Stacks on stacks on stacks on stacks, blocks on blocks on blocks on blocks. Now, the reversal. The infamous reversal. What is reversal? Reversal is when price moves the opposite direction that the current direction has taken. What is important about this? When price reverses direction, it indicates the market makers, aka IPDA, have ran a level of stops and a significant move should unfold in the new direction. Now, what do you look for? You look for the liquidity pools just above an old price high and just below an old price low, right? This is prime for turtle soup traders, for a turtle soup sell, a turtle soup buy. If you don't know what a turtle soup is, it's just selling above highs and buying below lows. But where do we expect price to reverse it? What do we call the destination? Not who lives there, but what do we call it when we're coming up to a specific point and we expect something to happen? What do we call it, gang? What do we call it? I can't hear you. Hey, wait a minute, wait. Is that Is that Valdez kids? Hey, how y'all doing? Hey, everybody, look, that's Valdez kids. Valdez kids. What do we call the point where we expect price to do something? Wait. Let me go full screen. Hold on. What do you call it? An anticipatory reactionary point. Very good, Valdez kids. Very good. I ain't got good sense, man. Let's get an example of this. Okay. On this chart here, everywhere you see an X, right? These are anticipatory reactionary points, right? You notice that price didn't reverse here at this low. Right? Price didn't reverse there at that low. It didn't reverse here at this high. Didn't reverse at that low. Why? Because those aren't anticipatory reactionary points. When you get to an anticipatory reactionary point, aka support or resistance, aka a supply or demand zone, whatever you trade, when you get to this area, you're anticipating a possible reversal. So if you're a turtle soup trader, you can sell these highs because you have your risk to reward set. You can sell these highs to take it back down to wherever your destination is. You can buy these lows to take it back to wherever your destination is. Okay? And if you notice right here, you say, hey, Tim, what just makes this random? You're doing hindsight. What makes this random area right here? What makes that an anticipatory reactionary point? Let's look to the left, shall we? To the left. Everything you want to know is over to the left. If you come over here, you notice there is a bearish order block sitting right here at this old level of support turned resistance, right? This is an old level of support that price broke through. Now we're trading back up to it and we hit it and backed off of it. So the next time you go up here, you're anticipating this to be resistance. So you're just selling at resistance or you're selling at a bearish breaker. Did I say bearish breaker the first time? I hope I said bearish breaker the first time. But if I didn't say bearish breaker the first time, if you look to the left, there's a bearish breaker there. Now, let's get to the last one, the consolidation. Consolidation is when price moves in a clear trading range and shows no willingness to move significantly higher or lower. What is the importance? When price consolidates, it indicates the market makers, aka IPDA, are allowing orders to build on both sides of the market. Expect a new expansion near term. Remember when I say when price consolidate, it's engineering liquidity. It's allowing sell stops and buy stops to build on both sides of the marketplace. So every time it comes up to a point, down to a point, up to a point, down to a point, up to a point, down to a point. Y'all get it. There's sell stops and buy stops resting above and below the market, right? What do you look for? The impulse swing in price away from the equilibrium price level that is found exactly in the halfway point of the consolidation range. Remember when we was talking about running your Fibonacci tool, right? You run your Fibonacci tool. In this case, Michael has anchored it to the bodies of these candles. You can anchor it to the wicks. The wicks do the damage. The bodies tell the stories. Depending on who you ask to wick or not to wick, it's up to you. But when you run your Fibonacci tool from the highest high to the lowest low of that consolidation range, equilibrium is the 50% mark of the Fibonacci, right? Now, what are you looking for? Impulses away from the 50% of the Fibonacci, right? That's the equilibrium of that consolidation. If you notice here, you went away from the 50%, came back to it, away from the 50%, came back to it. hung around the 50%, moved away from it, came back to it, moved above it, came back to it. And then it expanded away. Let's get to le homework. This homework comes directly from Michael himself. I wasn't going to waste my time making up homework for this when he already had good homework made up that I did myself when I was learning these concepts. So here's your homework. What you should be focusing on right now. This is straight from the ICT core content. Go back through price using the ES chart. You're going to use the continuous chart for this. On TradingView is ES1 exclamation point. And the continuous contract gives you more data to go back and look through. So you're going to have to use the continuous contract. So create daily price action logs with price charts. So with the daily chart, you want to have 12 months of data. Use the 4-hour chart. You want to have 3 months of data, 60-minute chart, at least 3 weeks of data, and 15-minute chart, 3 to 4 days of data, right? So what are you going to be doing with these charts when you make them, right? You're going to take note of where price showed quick movements from a specific level, right? You're going to note recent highs and recent lows that haven't been retested yet. You want to note areas on the chart where price has left clean highs and lows, right? Clean, smooth highs, right? You want to look for smooth highs and smooth lows, right? You want to note the days that weekly highs and lows form and what kill zones they form in. Right? This is when you get into the intraday thing. So like I always say, what time was the PD array made? What time? This is all it, right? Note the daily high and low every trading day and what kill zone it formed in. What time of day was it? This is all the stuff I be telling you, you know, when you're taking your notes. This is what you're going to do with this homework here. You're going back and you're just looking through price. For the people who don't do intraday trading, your focus will be more so on the daily chart, looking at how price moved on the daily chart. But for those who do intraday trading, all the stuff about the kill zones, you will be able to do that with the 4-hour charts, the 60-minute charts, the 15-minute charts. But for those who don't do intraday trading, all the stuff about the kill zones, you won't have that because that's all intraday price action. And with that, that brings us to the end of another episode of The Art of Reading Price Action. Again, my name is Timothy Lee Rogers Sr., aka Aranya Grande. I'd like to thank you for tapping into another episode, and I welcome you back for the next episode of The Art of Reading Price Action. Until the next time, y'all be safe out here in these trading streets. Gone.